On this episode of the Stock Market Playbook, we're joined by Travis Devitt. This is an episode you are not going to want to miss. Travis has spent time in the institutional space, at Goldman, at hedge funds, and in private equity and in the stock market, and has kind of landed in a very interesting spot that affords some excellent points of view. You're going to love what he is looking at, how he thinks about the next opportunities beyond AI and during this AI craze. Enjoy this episode with Travis. Okay, we're here with Travis, Mr. Stock Geek himself. And we're excited to talk. I feel like there's so many topics that are happening right now in the economy and the stock market. I'm pretty excited to get your take on a couple of things and just see what you're seeing. But we're happy to have you on the episode with us today. Thanks for joining us.
Yeah, great to be here. Thanks for having me.
Absolutely. So we were chatting a little bit before the recording. You're hailing from Austin, Texas. The hustle bustle of Austin.
Yeah, not typically known as your hedge fund hub or your finance hub, but we like our wake surfing, we like our barbecue down here, and it's hard not to love it.
So again, never been to Austin myself, but the barbecue places have a little bit of a reputation. I keep hearing about this Terry Black's. Is overrated or worth it? What's the word?
Yeah, no, I think it's definitely top 5. I think there's a couple I might put ahead of it, but Terry Black's is a really solid choice. You really can't go wrong. I mean, they do it right. You may have to wait a little while, but yeah, I'd say them, Franklin's, La Barbecue, Micklethwait. There's a couple others, but yeah, we have we're blessed with really awesome barbecue places here in Central Texas.
Man, well,
yeah.
I'm out here in Utah, and the one thing Utah does great is like super high processed sugary treat kind of related stuff that just causes diabetes. And so
we just got a swig down here. Actually, I think you guys are responsible.
What? That's our people, man. You got a swig.
We got a swig.
Utah takes soda to another level. It's every time I go to another state, and I'm not, I grew up in California, but I've been in Utah for several years, and I go to other states and I go, why is it not super easy to get like a 99 ounce like soda? Like, why is that hard here? But I guess because other places kind of care about their health and stuff. So it's we just go for it with soda. Oh, that's wild. Well, if I will be making a trip out there to Austin, I've got a bunch of reasons I got to get there. So I'm definitely planning on hitting you up so you can at least give me a couple of pointers for some good barbecue.
Yeah, please do. We'll make sure you leave with a belly full and some good times. There's good nightlife, good lake life out here. A lot of fun to be had. Just yeah, you gotta get down here. It's a great time.
Sounds great. That sounds great. Okay, looking forward to it. So for our viewers here, give us a little bit of your background. How did you end up in Austin and doing what you're doing? You're in the finance industry. What kind of got you here?
Yeah. So I ended up in Austin because I went to school here. Went to UT Austin, got a degree in finance. At that time, now over 20 years ago, sheesh, dating me a little bit, but basically, I fell in love with the stock market like right away. I wasn't sure. I was like thinking about engineering, thinking about finance, kind of went the finance route and just immediately was hooked. Love the dynamism of markets. Just love the fact that you could solve these puzzles every day and get rewarded with, returns and wealth, and just love the hunt for stocks, the hunt for undervalued stuff and the hunt for what other people were missing. And so, yeah, I actually, interned at Goldman in New York while I was there in college, and saw that side of the world as well. And saw the other desks sitting on the other opposite side of Goldman, the hedge fund guys who were making these, big calls and taking big positions. And I was like, I want to do that. And so I thought, find me the fastest path to becoming a multi-billion-dollar hedge fund manager. I want to be a titan of finance. And so I ended up joining a long-short equity hedge fund right out of school out on the West Coast, out in Oregon, called Stadium Capital. And they helped really train me up in fundamentals and modeling and all the core skills you need as a good fundamental analyst. And that was a great experience. I was there about a year and a half or so, and then got kind of out of the blue an opportunity through someone I knew to interview at an up-and-coming hedge fund in Austin called Teton Capital Partners. And they filed their 13Fs under Ancient Art as sort of a different name to kind of hide what they're doing a little bit.
Yeah. I love it.
started by a guy, another Longhorn named Quincy Lee. He had started with like, I think $2 million of friends and family money back in 2000 and just said, I'm going to go for it, and had a really phenomenal track record his first few years, and needed to hire a couple analysts. And, you could kind of see this rocket ship potentially taking off. And I also, there's not a lot of opportunities to be at a hedge fund in Austin, which was a town I loved. Sure. So jumped at that opportunity, got to go there. It was January 2008 when I joined Teton Capital Partners. And so auspicious timing. And we ended up, trying to navigate through the GFC, of course. That was our only down year at the fund for, I think, the first decade or decade and a half of the fund. And we were fortunate enough to like survive through it. We had, some redemptions because people needed capital, but overall navigated it, found some incredible opportunities. We got into distressed debt, some opportunities there, and came out of it with the fund's best year ever the year after. And it was just off to the races. And we're on Barron's top 100 hedge funds list a couple years in a row. So that was a great experience. But there was something, after about 8-9 years, I started to notice I'd kind of got bit by the angel investing bug and by the tech bug. But the other thing I noticed was that companies were staying private a lot longer. And so you weren't getting the opportunity to invest in Uber at an early stage. In the 90s, Intel and Dell went public as small caps, and Meta went public at $40-50 billion market cap, right? So there was, I could see this delay where a lot of the cool, exciting companies were staying private longer. And so I decided before the golden handcuffs got too strong, I was going to jump out of the hedge fund world for a couple of years, and ended up doing that. Went to San Francisco to learn for a bit, did some angel investing, and then joined an early stage startup back here in Austin called Aceable that was building mobile apps for education. And so I ran their growth playbooks for 4 years. We helped grow that business. Hopefully, knock on wood, we'll have an exit actually here pretty soon. We got VC funding there and built that company up. And then the last 5 years or so after that, I said, I'm going to take some time off. I think this AI thing could be interesting. I want to spend some time getting back into investing. It was just like my first passion. Maybe I can kind of combine the education side with investing because I really care about, people getting opportunities. And so, not just like making pension funds and endowments wealthy, but actually helping like your average person kind of navigate complex markets. And so, so that's how Stockgeek TV was born. And basically, the goal and the idea has always been since the beginning to, try to help your average retail investor, try to help investors better understand markets, help them understand fundamentals, help them find stocks that are intriguing. And, along the way, obviously managing family capital, but also just trying to, help demystify some of the complexities out there for people. So sorry, long-winded answer, took you through it, but hopefully that's insightful.
That is awesome. I think there's definitely a lot of great things to unpack in there, but first and foremost, I think it's so great. I run a fund and I've, worked with some individuals along the way that friends and family that say, hey, how do we do this trading stuff? And it's been super interesting over the last decade, right? About 10 years prior to that, there were just people out there trying to get money out of people with promises of, big gains and all this stuff. And then it seems like about 10 years ago, this massive group of just like yourself, like-minded, caring individuals that offer tons of great content, a lot of it free, very reasonable type stuff of how to really get involved in the stock market. And man, I feel like in the last 10 years, there are so many great resources, which is like really awesome because a lot of people, like yourself, sounds like, there's certainly a labor of love kind of involved in it, not just, can I get a bunch of people to pay me a bunch of money, right? Like really, I've had some success. I want to help other people have success as well. And I commend you for that. I think that's really great.
Yeah. I mean, some of my peers from the old finance days probably look at me and are like, what are you doing? I would have made a lot more money had I stayed in the hedge fund world. But it's not all about making the dollar number go up for everybody. Right. And the other thing I think is markets are changing, content is changing, like the internet is changing. Right. And so we've seen a lot of traditional hedge fund managers, starting to open up communication on social media. You got Bill Ackman writing, these crazy long tweets. You have, Dan Lowe from Third Point. You've got Druckenmiller doing interviews and podcasts now. But that was one thing that I saw early too. A while back was, there's this opportunity for creators to bring this to bring like people insights and education and entertainment directly, and then you can actually build that up and become, a big player yourself from that, or, in some
Yeah.
ways, like make a big difference, or even, see business opportunities flow from that, right? You look at the creators that are building businesses. I mean, Mr. Beast is kind of a silly example, but there are a lot of smaller ones as well that have now, been able to invest in other startups, or, get access to, now I see, some of the big finance YouTubers are actually like working for A16Z as scouts for angel investments. There's all these opportunities that flow from kind of putting your ideas out there, putting yourself out there, creating this public resume. So yeah, I think there's, it used to be that, oh, you're starting a newsletter, you're starting a course, so you don't know what you're talking about. Like, nobody who sells a course is, can manage money well, and that's just not true anymore. And we've seen that too with the rise of Substack and things like that, where people are, really putting out some incredible research, in some cases way better than what you might get on the sell side. So
For sure. Yeah. It is interesting, and it's great to see. I think some of the individuals and creators and so on were kind of thought, okay, you're a social media influencer or whatever, but they're getting taken very seriously, and getting a lot of attention from the institutions and the funds and so on. And you're exactly right, they're pumping out crazy good research and content related to all this. And so it's super cool to see. I love to see the shift happening, because the big guys have been in control of it all for a very, very long time. So I think it's time to there's some sharing that needs to happen, and there's plenty to go around for everybody.
That's right. That's right.
Yeah, no, it's awesome. So you've got a stock market background, a little bit of private equity background, it sounds like, some tech in there. What's your love these days? Where do you find yourself spending a slight majority of your time during the day?
Yeah. I spend, most of my waking hours these days focused on public markets, focused on stocks, and mainly to like help our community members at the Wealth Incubator, and then also, managing the family portfolios as well. But yeah, I mean, the cool thing, my career has been kind of both on the operating side and the investing side, and that's, by design. I basically figured out that to be a good investor, it probably helps to have some operating experience. And that's why I kind of jumped off that out of the hedge fund seat and went and tried, to help actually build a company for 4 or 5 years. And so that was an important experience. And I think it helped. And, I've sat on the boards of companies and things like that. So to see how that secret sauce is made kind of in the boardroom, I think very, very helpful in understanding incentives and motivation, and how some of the even public company directors act and things like that. So, but these days, investing is it's kind of like circling back to the primary passion that I found 20 years ago. And like you mentioned a couple minutes ago, like the markets have gotten so interesting and weird, and there's so much happening now. It feels like there always was, but I think now you look at even just a couple years ago, right? The GameStop debacle, which was, or the GameStop. Maybe debacle is the wrong word. For some, it was a debacle. For some, it was a crazy experience. And the way that retail is moving stocks and moving markets now, the way that now AI is changing, the way that content creators are affecting markets and affecting individual stocks, the way that Substacks are now. You saw the Citrini piece a couple weeks ago move the market and got mentioned on Bloomberg. So I think there's just a really, really interesting thing that's happened in markets where like the diffusion of information is so fast and so impactful, and retail investors actually do have a seat at the table. That's what's cool to me.
Yeah. We see so much. Like you said, the information so kind of readily available, and the reaction to it is quite swift. And it in some cases may give the retail investor a slight edge, right? I mean, it's a little easier to react to movements with a typical retail investment kind of portfolio versus a 10 or $20 billion situation that you're trying to move around. And so there's some good advantage there. But you're right. The retail side of things has gotten quite wild, quite exciting. Now, on your with your experience kind of in the institutional side, also in the operating side, how does that influence the stocks you like and what you pick, and kind of what's your approach there on finding some favorites?
Yeah, that's a great question. Yeah, I think one thing that I have noticed about markets in the last couple of years is momentum as a strategy has become so dominant. And momentum can obviously work very, very well, but it's also prone to heavy shocks. And, just I'll point out an example of silver just a couple of weeks ago. It was going parabolic, and then it had a 1 day 30% correction. It was like whatever 5 sigma move or whatever it was by the to statistical definition. But the the institutional side has changed as well, in the sense that a lot of discretionary long short has lost AUM, and pod shops and quant funds have gained AUM. And so what's interesting about that is that those are heavily momentum biased as well. They are typically systematic. They'll cut positions when they're down a certain percentage, or they'll focus on stocks above key moving averages, or stocks that are working in the current environment. They look at sector rotation. They have much shorter time horizons. So you look at the average holding, the time horizon on a holding for a stock, it's like 1/10 of what it was a decade or two ago. So
sure,
what we have is like this interesting dynamic now in markets where there's so much crowding. And so what I try to do is I try to go out and look at what is the market not appreciating today? Like, what is the market not thinking about? Where are the opportunities where the market doesn't care today, but they may care in 1, 2, 3 years time, or even, 6 months from now. And so, to give you an example, GameStop is a fairly obvious example, but, I was tweeting about that. I was probably one of like 10 people that were tweeting about it in the summer of 2020 when it was trading at $4 pre-split. And that was a situation where, the market had sort of left it for dead. But if you actually looked at the balance sheet and you looked at the cash flow profile, you looked at the liquidity and the options available for the company, you look at their lease structure on their existing leases, like there wasn't any imminent distress, imminent bankruptcy risk. And so with the short interest being at like 100% of the float, I was like, oh, this is an interesting situation. I actually tweeted publicly about it in August of 2020. And then 6 months later, the stock had 100x. And there's been a bunch of situations like that. Last year, for instance, I bought Micron at $60, $70 during the April tariff sell-off. And that was a situation where it was like, knew that, demand for a high bandwidth or high performance memory was going to, essentially be going up and to the right for the next 4 to 5 years because of the AI data center boom. Yeah. And yet the stock was down, 50% in a matter of a couple of weeks with the overall market. And so, what I'm trying to do is find these situations where, the market is saying one thing because all the flows are headed in one direction, but where I see kind of a fundamental gap and a fundamental inflection point, 6 months or 12 months out. And so, yeah, that's generally been a pretty good strategy for me. And things like there's a couple different buckets I put that. It's not all like turnaround stories like GameStop. That's not all short squeezes. It's stuff too where you see like profit inflections that the market is not yet rewarding. Last year, one of my biggest winner stocks was Wayfair. And an interesting dynamic that's been happening at Wayfair was like their EBITDA margins have been on a steady upward trajectory for the past 2 or 3 years. And the housing market has been weak. And so their category has been weak. And so revenues have not been growing super fast. But they have been taking share, and revenues are slowly growing in a category that's in decline. And in the meantime, their EBITDA margins, their profit margins are inflecting. And so, the stock ended up being a, 300 to 400% gainer last year because they blew out a couple of earnings results, and all of a sudden, you go from being a stock that's hated, that's sold off in the tariff sell-off, to all of a sudden now people pay attention to the fundamentals and they're inflecting. And oh, by the way, all the momentum funds are now buying it, and so it's crazy the extremes that you see. And so that's basically what I'm trying to focus on these days, is finding the extremes where the market isn't appreciating some future fundamental inflection.
That's an interesting position to take for sure. And there's always, in my brain, I've always kind of visualized these, compressed stocks, right? These consolidated companies that are doing well, but their stock is not reflecting it, right? It's kind of like that beach ball under the water. And it's like, when are we going to have enough reason for that to come popping up? And I mean, honestly, even in our, I have a chart right here of oil futures, right? I mean, even something like that, it's like, are we not needing oil? What is the reason? And of course, we've got all this, is the Strait of Hormuz going to be open or closed? What's happening? Iran, all this stuff. But it also just looks very much like a chart that has been so compressed, like any kind of, entity company out there that's just been completely neglected. And sometimes it just takes a small reason, right? Whatever that thing is. Obviously, this, was a little more of a medium reason, but you get that aggressive, quick movement. And we've seen that happen in so many stocks and so many companies. And so taking that kind of point of view, what's interesting, what looks good now, obviously AI is dominating the space, right? And it's, and of course we've got, some global conflicts sprinkled in there. We've got private credit markets that people are going, where's my money and what's the real number here? I mean, what do you see beyond? Are you looking at something beyond AI right now? Are you thinking, hey, in a year, there's going to be a huge, some sector is going to benefit hugely from what AI is trying to accomplish right now?
Yeah, no, it's a great question. I mean, I think it is difficult, right? You look at some of the AI winner stocks. You look at a SanDisk, you look at a Micron, you look at a Lumentum, you look at a Coherent, you look at all these infrastructure stocks are so bid up, and so many of them are parabolic, and they were last year as well. And I actually did a video on a lot of the AI infrastructure stuff on my Stockgeek channel at the end of last year. And one of the theses that I laid out there was, as we move into 2026 and 2027, I'm not actually concerned about the AI infrastructure bubble popping in the short run, because it's still very clear that demand for compute far outweighs the supply, and a lot of these big data centers just still haven't been built yet. And so we will probably end up with too much capacity 2028, 2029, maybe 2030. I don't know exactly. But what I think the market will start to do is they'll start to price that in before that. And they'll start to also think about, well, who are the actual winners in a world where we do have, a lot of AI compute now online? Who are the winners who are actually going to use the AI compute to make their businesses better? And so basically starting to move into the phase of like, who are the winners of AI applications rather than AI infrastructure? That's going to be a big thesis for me, and pretty much already is a big thesis for me. And so, it's funny because this year we've also had the SaaS apocalypse. And I thought actually coming into the year, I was like, well, there are some software stocks that I think will do really well because of AI, because as these AI features get built out, you actually can make some of these businesses more valuable, not less. And you start to be able to, have some growth levers in some of these businesses that maybe have been decelerating. And so AI agent opportunities, there's companies like UiPath, for example. That one I think has a wide range of future outcomes, but it is one where, you look at the rise of AI agents and you look at what's needed to deploy AI agents in the enterprise. And it is not an easy task. This is not installing OpenClaw on a VPS. This is like making sure that your systems don't break and that you don't have some catastrophic failure, while also trying to utilize, the capabilities of like these agent swarms. And so that's not an easy thing for large enterprises to do. And so maybe Anthropic is going to win all that business, but there are companies that are pure plays like UiPath that are out there that I think will take, some of the market, and whose stock do not reflect it at all. Its stock is trading like a software stock, like a pure software SaaS, vertical SaaS that's going to get totally murdered. And there is a small probability that happens, that all of their RPA revenue goes away and they don't actually capture any of the AI agent opportunity. But I don't think that's base case. And I see this opportunity for a company like UiPath to actually go out and help large enterprises and medium-sized enterprises, actually implement AI agents and make their businesses better, more efficient, and then give them more capabilities. And all of a sudden now you have, a growth company that is trading for 12 or 14 times earnings that the market might actually price like SanDisk is this year, right? What happens if all of a sudden they reaccelerate growth to 20 or 30% and the multiple increases? You could have, 3, 4, 5x type of stock on your hands. So yeah, I'm looking for situations like that where I think there's maybe the market is not seeing it yet, but there are some real potential winners on the AI application side. So I'll let others figure out the AI infrastructure stuff and when that bubble booms and bursts. But I've kind of moved on to trying to figure out like who's actually going to win in the application side of AI.
That's super interesting. I think the general population is really kind of digesting this AI situation, right? Okay, the internet has become useful again. We've got all this data, all this information. We can now use it. Consumer side, right? More of the enterprise side, that's going to be interesting. Like you said, I think obviously all these SaaS companies are just getting hammered. Is Anthropic going to be able to come in and just replace these guys? Create enterprise software, go.
Don't make any mistakes.
No bugs, tease. And so there's so much development that has to happen there, and obviously there's going to be some major trepidation from the C-suite of these big companies, right? Are we going to just take some, new up and coming software. And so, probably there's some interesting buy the dip opportunities on some of these SaaS related companies. And that's going to be super interesting to see how that plays out. But certainly, who can use AI the best, and determining who those people and companies and organizations are to be able to jump in on that has got to be the next kind of big play. So I think that's super interesting. Now, along the way, as like you said, and we've certainly seen this, the market is getting so concentrated, it's getting so crowded, right? I mean, we still have a vast majority in a handful of mega cap stocks. Do you see any companies getting left by the wayside that maybe shouldn't, that are still great companies, great buys? I mean, I think of like random retail stocks. I think of one stock that I just love to watch fall off a cliff constantly is Snap. I'm like, are these guys going to 50 cents a share? What's going to happen with these guys? And, and I barely have a teenager, which I do not let use Snap. But if you could, every younger high school, whatever age person out there communicates on Snap. It's their go-to, and their stock just can't stop getting murdered. Now, Snap has some internal issues, but and I'm not saying specifically Snap, but there's so many examples like this that just is we're looking so far into the future. Are there things in the present that are just getting completely forgotten about?
Oh yeah, absolutely. And I think Snap is a great example, and maybe I'm a little biased on that one. I actually, so I have a position right now and accumulated recently, and I wrote a letter to Evan and the board, Evan Spiegel, the founder CEO, because their problems are so self-inflicted. Yeah, there's some questions on the business side about, can they reaccelerate growth? How much are they investing in the specs business? Is that going to pay off, et cetera? But, they've actually done a pretty solid job of increasing margins over the past couple of years and getting to like a solid like EBITDA and free cash flow generation. But none of that really matters because they're issuing 10% of the share count every year in RSUs to employees and executives. And so there's a reason why a lot of investors have called it like an employee enrichment scheme, not a real public company. And so, it's basically so obvious to me that, the stock, I think probably is up 50 to 100% if they came out with a policy where they basically said, we're going to cut the RSU issuance in half. That would still be a very high issuance. 5% a year of your share count getting diluted is still very, very high. Like, like tolerable would probably be 1 to 2%, but, Snap is at 10%, which is just an absurd level of stock-based compensation for their company their size. And there's some other things too, like they have the dual voting, and so they don't even issue an annual proxy statement because Evan has all the voting in the company, and they don't care to issue a proxy. So there's some governance cleanup, right, that could happen besides the RSUs as well. So that one's, I think, a situation though where you kind of have to look at it and go, yeah, everyone hates this. The stock is down. It's all below all the key moving averages. Everyone thinks it's a joke, but there's some light there. There's some improvement. There's something there, right? It's a platform that has 900 plus million global users, and they've had a huge step up in profitability. So theoretically, if they could fix a few of the things that they're doing wrong, you have massive potential upside. And Evans even hinted that in his own employee letter, where he said, we have a potential for a VC like outcome now from these prices. And so it's an interesting one where I think a lot of people don't yet see, they can't look forward and see, well, what if, we see it as the company as it is today and all the issues it has, but what if you look forward in 1 to 2 to 3 years and they're growing faster, they've cleaned up some of the governance, and then what does that look like? And so that's a great example. And then you mentioned retail stocks. There's certainly, something like Chewy, which I think is a great business. The online pet store has been taking market share, and its stock is down a ton over the last 6 months. So I've been kind of looking at that one a little deeper, nibbling a little bit, but there's always, there's a bunch of stocks that are not in the headlines that, probably, if you can find and kind of do the work, you can, oftentimes, get them at really, really intriguing prices and sentiment where, again, like the crowd just isn't paying attention because everyone's focused on the same 10 or 20 stocks, like you said.
It is wild, but I think there's a balance you have to strike, right? What are the next biggest, best future opportunities, and also who's getting forgotten about, and what companies are still crushing it. Another just wild one that I love to watch. I have no positions on, but I watch PayPal, and I think I just love to hate PayPal, but
Pain Pal, as we call it.
Pain Pal. I mean, what are these guys up to? they just can't catch their footing, but their financials are not terrible.
No,
they have some things in there that it makes me think, when are people going to stop hating this, right? And when is there going to be an opportunity there? It's certainly one that is kind of like out of the corner of my eye. I'm keeping an eye on it.
Yeah, that's been a tough one for me. I had a position going into the early part of the year, and obviously I did not expect the CEO to just get fired out of the blue, and for what happened to happen, and then bring down guidance for the year. And the lesson for me there is, cheap can always get cheaper, and I've known that, but it's position. That's why position sizing, I'm sure you spend a lot of time thinking about this as a fund manager. Position sizing is so key. And we tell that to our community members a lot. It's like, you don't want a mistake, because there are going to be mistakes like that. You don't want a mistake to take you out of the game or impair you in a way that's permanent in your portfolio. Yeah. And so position sizing is really key. And thankfully for me, it did cost, I think, around 1.5% of total capital was the realized loss that I took on it. And I may look to get in at some point, once they kind of establish who their new leadership is going to be and what their strategies are, maybe the stock is still cheap. I don't know. But yeah, I mean, there's situations like that where, you're not going to be perfect. No one bats 100%, not even Warren Buffett. Right. So you have to know that you're going to have those times where like something is going to blow a little hole in your portfolio, and you just got to position it so that it doesn't become existential risk to the portfolio. And so we talk a lot about position sizing, portfolio management in that respect.
I think that is so important, because you're right. I mean, in my own fund, I mean, we've had some great years, and you don't have to have, you don't even have to be 80% accurate. You don't have to be 70% accurate, and you can kill it. But position sizing is so key. And I think that's certainly, on the retail side of things, in the retail space, is probably where a lot of people feel the pain. I mean, I hear, speaking of Snap, several years ago, I had, when did they go public? Like 2017-ish?
That's right. Yep, 2017.
Right around there. And we had seen a lot of big, or we'd seen a lot of tech IPOs kind of leading up to that. Facebook/Meta wasn't too long, but a couple years before that. And we were seeing all these, and I think Twitter had gone public maybe 14, 15, somewhere in there. Mm-hmm. and or maybe a little earlier. But anyway, one of my good buddies, who's a doctor of all things, he's my age, and he said, I need a good stock recommendation. I said, well, Snap went public. I said, let him dip for a little while and buy him. And it turns out he dumped his whole entire 401k and bought Snap 100%. And unbeknownst to me, luckily, they went up hundreds of percent, but it is funny how some people, the risk appetite is not even it's not even a discussion. So that scaling in, that's what we like to do. We position size is crucial, especially in this market where something is up 200 or 300% in a week and then down 50% the next week, right? And to be able to kind of withstand those swings that we see on a semi-regular basis in this market. I mean, I'm sitting here looking at crude that's, down 30% in the last 2 days, right? And everybody thought, which it is always interesting how the gas stations reflect crude prices up immediately, but down not so immediately.
That's right.
But interesting to see the amount of volatility and how quick things are moving. And so now, do you, in your own trading, are you kind of straight equities? Do you do anything with options to take advantage of some of these wild movements?
Yeah, I do. Yeah. So I've, utilized options for a long time. Like, I actually came up, one of the opportunities I had when I was, an intern back in college was rotating on some derivatives desks at Goldman. And so I learned derivatives back then pretty deep, and have used them as a tool. But I do think, I try to limit the amount of options as a percentage of my portfolio to less than 10 to 15% of the portfolio at any given time.
Sure.
And then each options position, I try to size appropriately. But it's funny. Last year, you were talking about win rate earlier on options. My win rate last year was only like, I think 25%. So 1 out of 4 positions were profitable. However, my total options P&L was significantly in the green. It actually added significant alpha to my portfolio last year. I think it was like 10 percentage points of performance, because on those winners, they were such outsized winners that
Sure.
they more than made up for the losers. So that's always key, is like, with options, it's just thinking about position sizing, not getting too over levered as a total percentage of your portfolio, because I have noticed at times when I tend to get too many options positions at once, I later find that ends up being a headwind for the portfolio. Like historically, I found that if it's kind of a greed indicator for me in a way. It's like maybe I'm taking too much risk. And so I try to be thoughtful now about having learned from like past mistakes. Like I did a pretty sizable SPAC warrant portfolio position a couple years back, and learned, that kind of burned me as well. So there's been some learnings over the years on the options front, but I think I've kind of dialed in the risk management there, and definitely utilize them, especially in certain situations. Like I'll give you an example, like Chinese stocks. There's such a unique risk there as a US based investor holding a Chinese stock that could get, put on a sanctions list overnight. And so, yeah, as it sounds like, so I don't like to, I don't like to hold the spot. I actually like to try to find like a 5-to-1 or 10-to-1 risk reward via options, where I can put up less capital, still have good upside, but not put as much capital at risk in a situation like that.
Man, the Chinese stocks are just a supreme example of that for sure. But that is great. So where, when you look kind of at public markets right now, where do you think the biggest risk is that nobody is talking about?
Yeah, I definitely think it has to be, recession risk. And I think more people are starting to come around to that. But the idea that if AI does actually start to contribute to job losses, things could cascade pretty quick in the short run, because you've got, and now also with the geopolitical risk and the inflationary risk from oil, the Fed could be put in a very tight position where you'd want them to be cutting, but they can't, because oil prices are causing inflation in goods in the short run. So yeah, I think there's a big risk that I'm just keeping an eye on the jobs market. We saw Block, aka Square, laying off 40% of their workforce.
Right.
And there's a lot of evidence to suggest that that's Square specific, and not necessarily because AI is coming for all the jobs that quickly. But there is a little bit of probably AI impact there, and if other companies start to follow suit, it's like the companies are making rational decisions. Hey, we're going to increase margins by cutting headcount, and that's fine on an individual company basis. But as you know, if you get enough companies doing that at once, then now you've got an economy-wide problem and a destruction of demand, et cetera, and that's how we get recession. So yeah, I'm kind of watching the jobs numbers. I think there's some latent recession risk there that we just have to respect and kind of monitor.
How are you thinking about your next moves if we get recessionary reactions from job loss and whatever other things might be happening?
Yeah, no, it's a great question. I mean, I think you have to just, be lightly positioned in areas that are overcrowded, or companies that have, fundamentally high leverage on the balance sheet, things like that. So, I look at some of these BDCs that are trading, 40% discounts to NAV, but I'm like, yeah, but this could get worse, not better in the short run if we go into recession, So I try to think through that lens as well. And then, you mentioned earlier the crowdedness of certain trades like big tech. And there's 40% of the index in 7 or 8 stocks. And so I think even those are not super expensive stocks, people are going to probably look to sell what is heaviest weighting if markets are going down. And so, yeah, just trying to be thoughtful about exposure to areas of the market that are widely owned. And at the end of the day, like honestly, for me, just having raising cash balances as things get worse would probably be the way that I would do it. I try not to like short too aggressively or hedge, so to speak, too aggressively, but occasionally I will put on some hedges when I think the market is, pricing them too cheaply. But for me, it's just about trying to create like a a diversified, non-correlated portfolio, have some cash reserve, and then, buy that dip when it gets deep enough. And I know that I'm going to take some drawdown through a period, like if we get another, 2001, 2002 style, or even it's funny because we haven't had that kind of a recessionary market probably since, even the GFC, I think, is a little bit unusual because of the banking system sort of collapsing. It's like, when was the last time that we faced just a kind of garden variety recession where the market was just flat to down for a couple years? It's been a while, right? So that's the environment that I think will be tough for a lot of people.
Yeah, that will be interesting. I sometimes find myself looking at like a really long-term like S&P chart, right? Like, a long-term time increment, maybe, 20, 30-year chart. And if you look at just say like a 200 period average price of like these long periods, it's the S&P, it's very rare, at least over the last basically 30 years or so, that we really make much of a dip below that kind of 200 period average price, whether it's, a day, a week, that type of stuff. And I think, are we due? 2000, .com, all that happened, and that was an extended period kind of below that average moving price, right? Like 2 years, right, for the market to improve. And then of course we had 2008, and that was much quicker. That was, 8 months, several months kind of down there. And so I think the question that kind of has to beg is if we get down into a situation like that again, right? Will government stimulus and spending, 2008 was kind of the beginning of that stimulus to help the economy recover. Whereas 2000, they were just like, we don't care. What's the internet? Let's just move on with our lives. And it had to kind of trudge its way back. And then 2008, we were like, this could get really bad. And now there's just a finger on the trigger, right? How much money do we need to pump into the economy? We're ready for it. And so it does make me wonder, if there is a big shock, a big dip, will the market respond as it has over the last, 15, 16, 17 years with stimulus kind of buying, and what will that do to the, perma bulls? And of course the 1% of perma bears out there will be stoked about it. But it's interesting. It's interesting. And so I think, it's a great point you make on just, I mean, we're in cash a fair bit right now, and that may be increasing, and kind of just having dry powder to take advantage of those dips, because at the end of the day, we get big dips in the stock market. You got to work your way into those positions, and it's always the most painful time to do it. It's funny psychology. It's like, something's on sale in the stock market, I don't want it. Give me like top price, and then I'm going to buy it. And so, yeah, I think those are great things to keep an eye on. We saw a lot of recession talk a couple years ago. It was very soon, but it seems like there are a couple of signals now to very much pay attention to in that space for sure. So, yeah, that's a great point.
It is hard, I guess, to imagine when the hyperscalers are spending like 2% of GDP on AI data centers this year. It's hard to imagine you're going to get a recession, but I think it's and maybe it's more of a 2027, 2028 risk, but it is something that, like, I think with that AI kind of unknown impact on corporate hiring and corporate firing, it's just something I think to keep on watch for sure.
For sure. I mean, on the AI side of things, if I think the fear of AI is going to completely replace me is probably gone a little bit, but think about if one person can do a 2-person job with AI, which is very, 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 very doable. That's a potential of 50% reduction in a workforce in certain areas, right? Yeah. And so it's significant. It's significant. It's interesting to think about those numbers like that. But that's awesome.
I'd be curious to get your thoughts on how AI is impacting your workflows. Are you feeling like 2026 is a year where you're really changing how you're doing your daily work with AI tools?
Yeah, that is super interesting. I think certainly in the fund management kind of space, AI is ridiculously helpful. Mm-hmm. We always have a couple of quants and analysts working on various things, and so much of that can be done now with very little effort. I mean, we were doing so much just hard coding and back testing of, you know, our quant strategies and so on. And it was so time intensive and labor intensive. And it, like, almost overnight went like this and just got so much easier. And, you know, and myself, in managing the fund, you know, I need half as many analysts now. It just, the workflow has gotten so much easier and has gotten so much more efficient and so much quicker. And it's ridiculous. You pay $20 a month to get an updated, you know, an expanded version of Claude or ChatGPT or whatever, to just round up, you know, mundane data. I remember it was a year ago, that I was saying, okay, we need to make some hires of people that can just aggregate and clean data, you know, and we were going to pay people to do that. And then all of a sudden it was like, oh, $20 a month can get that done now, you know? And, and so I think certainly in the financial space, in the research space, in kind of putting all the data together, that, I mean, I don't know if there's another industry out there like the stock market that pumps out so much data on a minute by minute basis, nearly 24 hours a day. And so to be able to kind of sort through that and make sense of that, AI has been just monumental in our space. So, yeah. And I'm sure, you know, I'm sure you're seeing quite a bit of that in your own research and probably in a lot of content related stuff. I mean, it's just a different game now.
Yeah. And I think that inflection really has happened in the last 6 months. It's like before, when we were like not sure about the economics of hiring someone for certain things around, you know, content or perhaps even like a, you know, a junior analyst. Now it's like we can get that new junior employee to do these different tasks for very, very low cost. And the quality is actually now at a baseline level that's good enough. And so it's, at least for some tasks. And then there's other stuff where it's, you know, you still need, like, just, you know, there are deterministic things where it's like, yeah, I'm not going to trust Claude to go in and, you know, do certain things in my backend database, but at least not yet. But but we're almost thinking of it though right now, you know, Wealth Incubator as sort of like a way to sort of have a team that we might not have been able to hire otherwise. And so for us, it's more incremental. Whereas, you know, there are some businesses where they're probably going to look at their payroll and go, maybe we could cut 10% of these and we'll keep the same output with AI. But then for other companies, I do think they're going to look at this as an incremental, you know, productivity boost. And so where that all nets out, I think is, you know, we were talking earlier about that recession risk. That's just what's so hard to figure out, because for sure, some companies are just going to be able to do more new features, new stuff, faster iteration, more cool stuff. And then for other companies, it's just going to be a pure cost saving measure. So where that nets out is just anyone's guess right now.
For sure. That is going to be super interesting because you're right. It makes you more efficient. It gives, you know, a lot of resources that, you know, were cost prohibitive prior. But I mean, the only thing I can think of right now is there's a lot of whale blubber salespeople out there that are going to be like, what is this? Kerosene? You know, I mean, this is such a shift in industry and in the overall outlook. And I think, you know, I think at the same time, it gives small and startup businesses such a leg up.
It does.
Right.
Yeah.
It gives such an opportunity to, you know, the bootstrappers out there that are trying to create something. And also, if you've built a house lately, it's not going to help with what plumbers and electricians are charging, because that's through the roof already. So, you know, the trades are still going strong, but it's an interesting space, and what an interesting time to live in. And you know, I love having these conversations with people like you that, you know, have, I mean, we're kind of old timers in the industry now, you know, I've been in it for 25 years and people are like, oh, you're still alive. Congratulations. You know, and like, but because it's changing so rapidly, but what an exciting time to be involved in all this. So it was a great discussion. And tell people where they can find out more about you. Stockgeek TV, you know, give us your outlets.
Yeah, thanks. Yeah. So Stockgeek TV is, you know, my personal content brand. I've got a YouTube channel and I'm active on X. And then I'm also I'm a mentor at the Wealth Incubator, which is our community for people, you know, kind of a premium subscription community for people to get access to, you know, real-time ideas, research and lots of other, wealth planning stuff, portfolio management stuff. And so, yeah, Wealth Incubator, if you're, serious about actually taking your investing to the next level. And if you just want to see, some cool stuff once in a while, then check out Stockgeek TV.
Yeah, absolutely. Okay. And we'll make sure to post all the links below the episode as well, so everyone can find you. But great discussion. I think you have an awesome outlook on so many things that are happening right now. And I am enlightened. So thank you
Thanks,
for sharing. And I think all of our guests will love this episode as well. So let's stay in touch and have you on again in the future.
That sounds great. We got to get you down to Austin, Jared.
I'm on my way. I'm a barbecue purist. At least I think I am. So Austin awaits. I can't wait.
It's going to blow your mind.
I'm excited. Thanks for being on with us.
Thanks. Cheers.